Perfect. So today we're going to talk about creative financing with the portfolio and what that means. So with anything financial, it's typically very much analytical and numbers. And so this is a way we'll use our right brain a bit and think about different ways to, again, fund primarily short-term needs, not always, that you might come up with. So a bit about Bogart Wealth, just before I dive in. If anyone's watched this before, you know this bit and you know us well. But our mission is to provide our clients with peace of mind by preserving intergenerational wealth. So we are really here to, as it says across the top, provide that financial peace of mind through the holistic planning that we do. We are just shy of $3 billion in assets that we manage, and there's approximately 1,300 families that we support. We are a registered investment advisor, which means we are independent. We do act as a fiduciary, which is always putting your best interest first. We custody our assets at Charles Schwab, so that's where accounts are actually held, where you see statements and get tax forms, and that's for your protection and safeguarding that they're there at that third party. And we do, we're fee only. So the only way that we make money is through the fee that we charge for any portion of the portfolio that we manage, and we do manage our portfolios here in-house. And I'll go over and talk a bit about our team as well through the next few slides. So these are the advisors that we have. If you've been with us for a number of years, you've seen a lot of growth, and hopefully this continues as our demand increases and stays pretty persistent with our clients. Right now, I am sitting in McLean, Virginia, and as you'll see, there's a number of advisors here across our 3 different locations. So we have a presence both in Texas with 2 offices in Texas, and then really our headquarters here in McLean, Virginia. Here's our team, our great marketing team, HR, Michelle, and our, you can see here compliance right here's kind of the ones who run the show. Most of them sitting here in Virginia, but again, kind of a blend of Texas and Virginia. We, of course, have our operations team. Although we do custody at Schwab, if you have a transaction need, that doesn't necessarily mean you're calling a Schwab phone site to do that, as we do our own assistance with any type of needs like that in operations. So we do have a team here. You've probably talked or interacted with a number of them. And then this is the group that is managing the portfolio. They are making the decisions day to day, run by Alex. Here are our portfolio management team. Again, sitting very nearby, but they are actually making the decisions on what to own within all of the portfolios. Here's our 3 different offices that we have. So Houston, there at the Gessner office, the Woodlands, and then in McLean, where I am sitting right now. So for us, as always, really at the heart of what we do is financial planning. And these are some of the facets of financial planning. I would love to say this covers everything, but of course they break into many subcategories. But here's a lot of the different kind of broader topics that we do help our clients with. This is kind of a list of some of the series that we've done. As y'all probably notice, Shaish and Christine, our great marketing team, have done a really nice job of, lining up a lot of content based on demand, based on feedback that we're getting for clients that they want, whether it's a podcast or a webinar that they can go back and listen to. So please let us know if you do have suggestions or things that you like, as we're continually trying to fill this out and create even more. Just so you know, if you want to come back and listen to this, to maybe revisit a topic that I went over and just want to listen again, or you want to share it with someone that you think it would be relevant to, if you're a current client, you can see it actually on your Black Diamond page on that Bogart site. To the bottom right, you'll see there a link to our webinar recordings. Or if you go to the Bogart website, there under resources, we have a library of these as well, if you want to go and listen to another topic that might seem interesting to you. So let's dive in and talk about creative financing. Again, typically a short-term bridge, not always, but that's primarily what we're going to talk about, what you'll see through some of these examples that I'm going to provide. So here's, some of the ways that you can finance larger expenses. So a home equity line of credit, a pledged asset loan, or PAL. We love acronyms in finance. So PAL, also called, some firms will call it a security-backed loan, a margin loan against your portfolio, intrafamily lending, and a 60-day IRA rollover. So a couple of ways. So for a home equity loan, and really any of those that I just listed, again, primarily these are things you would be using for a short-term need, with the one exception being the intrafamily lending. And we'll talk about how those can be structured. But anything else, typically it's just kind of a, hey, here's a short-term need or a bridge. A very common one that we see, especially over the past few years, is you have a home, maybe no mortgage on it, maybe you do, but you're in your current home and you want to move, right? You want to buy another home and then sell yours. But the market, particularly here in Northern Virginia, and I think, probably where you're sitting as well, it's a very competitive home buying market. It's very tough to do. So to come in and have this offer of, I want to buy your home, but hey, it's contingent on me selling mine, or I want to be competitive and pay cash, but maybe I don't have that full cash payment, right? So if you're trying to say, hey, no, I'm confident I can sell mine soon after, but I really want to get this home. I don't want to miss out. So I need a large sum of money right now to do that. That's a very common one that we see. Making a large purchase and you want to spread the tax it over 2 or more years. For example, if you are, maybe you're retiring this year or just have a larger income for whatever reason, you have unusually high income for the year, adjusted gross income, but you're going to retire next year, or maybe that one-time bonus that was this year, won't be repeating in 2025. For whatever reason, you can look forward to say, I'm going to be in a lower tax bracket next year. If you need to fund a large purchase from pulling from a retirement account or some type of account that is going to incur a capital gain, right, or a taxable event, it could be advantageous to say, hey, I'm going to give myself this short-term loan this year and then push paying that loan off, making that pull from those investments, whether it's, again, IRA or capital gains next year, to when I know I'm going to be in a more favorable tax rate. Now we want to do a little math for you, right? Because if the interest you're paying on this short-term loan is greater than, the tax savings that we'd foresee, right? Let's think about it. But that's another way that we commonly see it. Again, wanting to help children, grandchildren buy their first home, really any short-term liquidity needs, just sharing a few of the most common ones that we see. So let's dive in. We're going to talk about a home equity line first. And this is one, I'm going to guess that if anyone's familiar with the original list, this is probably one that you have had experience with or have heard of. So truly, if you're looking to do any type of renovation on your home, maybe it's a roof, it's something, a new porch, whatever it is, if it's something that you're going to do to improve your home, then the first thing I would say we want to look at is a home equity loan, and I'll tell you why. So a couple of things about it. There are some tax benefits, or can be some tax benefits, if you use a home equity line and you do use it for that, right? So to buy, build, or improve your current residence, then the interest can be deductible. Now, it's subject to a limit, of course, thanks to the Tax Cuts and Jobs Act referenced here. You can't deduct more than a total of $750,000 if you bought since 2017. So $1 million if it's before then. After 2017, $750,000. So if you have a mortgage, HELOC is a second mortgage, essentially. And if your mortgage is already at $750,000, then you're hitting that cap. So the interest wouldn't be deductible. If you're taking the standard deduction, which many people are now, again, because of the current tax law that we have in place until the end of 2025, many people are, when you add it up, it's better for you to take a standard deduction than itemize. well then if you're not itemizing, this is a line item within there, it's not giving you the tax benefit. So that's when we say it could provide a tax benefit. And if it does, then I would always first explore a home equity line of credit to see, maybe the interest rate is 7%, but with the tax benefit that you get, that true interest rate would probably be more favorable than some of the other options that we'll discuss today. A home equity loan can be available to you if you have any equity in the home. So even if you have a mortgage in the home, on your home still, if you have enough equity, a lot of people do, or I find for most people, their home, their real estate's one of their largest assets. It makes up a big piece of that net worth statement. Then even with the mortgage, there could still be room to take a home equity loan because there's kind of a ratio of that debt to home value that you have. The interest on this is variable each month. So I know a lot of clients probably loved their home equity loan if they took it out, in 2020, 2021. And then now we've seen where these rates are currently on those outstanding loans closer to 8%. And that's just an environment of the current interest rates. So it does fluctuate. There are some, I really don't come across many where you can lock in that rate, but typically you're going to see it fluctuate each month and you're paying interest only. So, as the example here, I didn't come up with it, but, use the funds to enclose a porch, you can deduct the interest. If you took the whole family to Disney World, it's not deductible. Another thing I would note is that if you have two properties or more than one property, if you take that home equity loan on your primary to finance your rental property or your second home, that would disqualify it for being deductible. So you can use it for a number of things. You can only deduct it if you're using it for improving your current home, the home that you're taking the loan out against. So to sum it up, some of the pros here is, again, it can typically have lower interest rates versus an unsecured loan or just taking a personal loan because you do have that asset that's backing it, right? You have that IOU. If things go north, then it's against your home, leveraged against your property. The interest could be tax deductible and flexibility. So you can pay it off early if you want to. There really, for many of these, there technically isn't a maturity date. I would say most commonly I see you can, over a 10-year period, pay it back as you will. And if there's still a balance at the 10-year period, then the bank will refinance it to be principal and interest. But typically it's interest only. So you want to at least pay the interest. If you want to pay above that to chip away, or again, if you know that there is a future bonus, a future income from your restricted stock units, right? If you know that you're using this in the short term, and then we'll just quickly pay it off with that future source of income, that's ideal and when we would recommend it. The interest rates are variable, so that will be a common theme for a lot of the financing options that we discussed today. You could lose your home. So in this scenario where your home value drops significantly, right? Again, you need to kind of maintain that debt to asset ratio. And so, if the home value, again, significantly drops, because usually there's a cushion in there, they're not going to let you take out 100% of your current home value, then the bank will say, hey, you need to pay back a portion now, right? Or you could lose your home. So an extreme one, but one to disclose nonetheless. Reduces your equity cushion. And yes, as I just said, if the market value declines, then the lender has the right to demand additional funds. Let's talk about next a pledged asset loan, again, or a PAL, as I might, I'll say that now just in case I use the acronym, but a pledged asset loan. Now, this is something that is specific and only available to your non-retirement assets. So if you're listening to this and you are primarily IRA, 401k, pension lump sum, right, a qualified or retirement asset, this is not an option that would be available to you. So this allows you to take that non-retirement portfolio and borrow against that. So again, here's the collateral or the asset that you have. You are taking a loan to utilize that asset that you've built up. The way it works is, you have your account, your brokerage account, wherever it is, right? So with us, that's Charles Schwab, but wherever it may be. So you still have ownership of all of your investments within that portfolio. You're still going to get the dividend income that may come from it, the appreciation, so the upside or the downside, right? Nothing changes with your kind of ownership and ability to still participate within that portfolio, but it's a loan that you have again against that portfolio. Typically, these are about, which you're allowed to borrow, is typically 70% of your account value. It depends on the makeup. It depends on if the securities in there are ones that are eligible to be borrowed against. So there are a number of factors. Don't take away and say, if I've got 100,000, Morgan told me I can take 70. That's a rule of thumb. And when you apply for the loan, you can see your exact amount that you're eligible to take. You don't have to take that full amount, but that, will come through and they'll say wherever you're taking it. Again, Schwab, Fidelity, wherever the brokerage account is, they'll tell you the amount that you're eligible to borrow on the account. I would say a really common reason that I see clients use a PAL is that you don't want to sell the investments in the account. And that could be for a number of reasons. A big one being you have this expense, but it's a bad time in the market. Where, March 1st of 2020, by golly, you've got something that you need to buy. There's a new car. There's something that has to happen, but you don't want to be forced to sell your investments at what is a really big drop in the market. You can't call the bottom, right? But the market's at a lower point. And so that is a big reason why I would recommend, let's explore this strategy so you can stay invested as it comes back up and sell at a different time. Again, for the same reason prior, with the HELOC is, trying to spread out a tax bill over a number of years. So if you have a lot of embedded capital gains, if you have a low cost basis in your brokerage account and don't want to take it out, maybe taking it all out this year would impact your Medicare Part B premium because of your AGI. Maybe it would push you into the threshold to where your capital gains tax is 20% instead of 15%. So again, all of those considerations could be a reason to, take the pledged asset loan now, pay that interest, it's interest only, and then in a following tax year, if it's more favorable and makes sense, then sell the investment when you're ready, pay off the loan. There's no maturity date, again, technically on this. So it is interest only. The interest is variable each month. And there's no maturity date necessarily. You could have just the home loan. Again, 70% roughly is that kind of amount you can borrow. If you really max it out, you take that 70%, the market keeps going down, then you're going to get a letter and a call from Schwab in this example, and they'll say, hey, you need to sell something or move more cash to the account. So again, aside from that, there's no date in which you have to pay it back. So same kind of summary for a PAL or a pledged asset loan. You retain ownership. You're still getting the dividends. You're still participating. You're still getting the growth in that portfolio and don't have to sell. Typically, again, a lower interest rate than just getting a personal loan or an unsecured loan because you've got that asset to back it up. You can avoid capital gains tax from selling. Defer capital gains tax from selling might be another way to think about it. Again, just depends on how you're repaying that loan, whether it's from new cash flow or ultimately selling, but just in a more favorable tax year. There's no deduction of the interest on these. You cannot use a PAL to buy more securities. We'll talk about what you can use if you're trying to use a loan, not for a new one-off purchase, a car, some of the things I've listed, helping your kids out, but you just want to leverage yourself. You think there's some good buys, there's no cash, right, that you have to invest more. You want to put more into the market. This is not available. You cannot use a PAL to buy more stocks. That would be a margin loan, which we will talk about. It could lose the securities in the event of the default. If the pledged securities decline, right? And I would say a investment portfolio is probably going to be more volatile and subject to that than a home. I mean, we can think of extreme examples in 2008, but again, you're subject to those capital calls and demands based on the overall value of the portfolio. Margin lending. So what ways can you borrow against your assets if you want to use it as an investment strategy? And the way that you can do that is through a margin loan. So for a margin loan, it is going to be very similar to the PAL. Your asset that you are pledging, that you are collateralizing and borrowing against, it's your investment account, your non-retirement investment account. So this is another way that you can leverage yourself again if there isn't cash in the portfolio and you want to use it as a buying opportunity. You do have to apply for margin. So for any of the ones that we've gone over so far, there is an application process. I would say of the three, the home equity loan, the PAL, and the margin, margin is probably the quickest, although a pledge asset loan can be, but margin's probably the quickest turnaround time in terms of applying for it and then being approved and having access to it. It's usually within a day or two. No need to set up a different account. Again, you still own the account. It's going to look and feel exactly the same in terms of your brokerage account, but then you'll have this loan layered on top with the margin. Margin interest is typically fairly comparable to the PAL. It really depends on how much you're looking to borrow and lend. So again, this is one where as the financial advisor, I would look at the rates. If, here's what we need, let's think through all of the different ways and compare the interest rates side by side to understand. Because although margin can be used for leverage yourself to buy other stocks, it can be used for other things as well. It isn't only subject to that. So again, sometimes higher interest rate than PALs. We always check them both because you want to make an informed decision. So let me go and shop all of the rates across. Lower initial amount. So this is a good one to consider. Often with a PAL or pledged asset loan, your minimum amount that you need to borrow is $100,000. And that can differ slightly depending on where you're getting it. But primarily, I see it around $100,000. For margin lending, you can take out margin, at $2,000, $3,000. So for margin lending, if it's a smaller amount, that would be another reason that you would use margin instead of a PAL. So based on how much you want to take out. More rigid maintenance requirements. What does that mean? So I said that, often you can borrow up to 70% of your portfolio value with that pledged asset loan. For margin, it's a much lower percentage. And again, it depends on the investments in the portfolio, but it is typically a much lower amount that you can borrow based off that same size portfolio. There's no closing cost for this. Same for a PAL. There's no initiation cost either. No qualifying requirements. Again, it's a pretty easy, kind of application that you go through to be approved to have margin on your account. It isn't on there by default. You do have to take an action to apply for that. And it's, again, very easy to do. Often you can just do it right online. The cons are, it's based on short-term rates. Rates are higher. Again, your margin rate is going to vary over time. It isn't a fixed rate. Again, I know I'm saying that for all of these. Not all securities are marginable, so you can't just look at your portfolio, see the balance, say, I can take 50% of that, 30% of that. Again, you need to work with your advisor or the broker you're working with to say, what's the amount that I can borrow? Same as all the others. The securities decline, you're subject to a capital call, and we'll go through kind of a simple example of that as well. Okay, so here we are. So a maintenance call, what does it mean? So the biggest risk you have with the PAL or margin loan is a maintenance call. Capital call, margin call, a number of names that they use for it. So in this simple example, if your portfolio is worth $100,000 and Schwab says, great, you can borrow 50% of that or $50,000. You need the full $50,000. So you take that out. the portfolio takes a dive, right? The market hits a rough patch, and that 100,000 now pulls back to 70,000. We're subject to that 50% rule. So what would happen is, again, you would get a letter, you would get a call, an alert to say, you are now borrowing, the amount you're borrowing is greater than this percentage of your portfolio. So you could, if you have it linked to a bank account or cash in another account, you could add cash, you could add other securities. So you can either take something outside to bring the value up. And if that isn't an option, then you're going to need to sell something within the portfolio to pay down the balance. So got to get to that equation one of those two ways. So this is just a nice kind of lineup of the three here that you'll see, some of the pros and cons. I think this is a great reference point. So really depends on, what you're borrowing, the amount that you need, the reason that you're taking it out, a couple of different variables that could lean you into one or the other that we're always happy to go over with you, explore, and help you make that decision. Again, for most of these, interest is variable. The amount you can borrow varies. The interest is going to vary. So really just depends on what's going to make the most sense for you in terms of that need and that amount. All right, using a 60-day IRA rollover. I'm going to say this is the riskiest of all of them, in my opinion, and not something that I would necessarily lead with, but it's an option. So I want to tell you about it, and I've seen a couple of ways with clients it worked really well. So that's why I thought it was worthwhile to include it and bring it in here. So when you have an IRA, unlike your 401k or savings plan that you have with your employer, often those have a loan. Not always, but there's ways to kind of borrow against it. You don't necessarily have that with an IRA. This works in a sense like a loan from your retirement account. You can do one per 12 months, and they are very strict about that. If you have 10 retirement accounts, it's still just one. I've seen people try to get clever and say, well, I'll take, one from here and one from here. No. This is once per year that this is an option for you to do. And the way it works, you take the money out. The day that you take that money from your IRA, the clock starts ticking. And you have got exactly 60 days to replace those funds back into the IRA, whether partial or in whole, ideally in whole. And if you do, it's as if it didn't come out. It is not a taxable event. So if you pull $50,000 from the IRA, you wouldn't want to withhold taxes. If you're certain it's coming back in, right? No need to do that. So you pull the $50,000 out. You know that you have, again, it's an RSU, it's a bonus. There's this certain income that is within the next year, just shy of it, right? And you know it's going to come in. Then once it is, you put the $50,000 back into the IRA. So again, this is a very specific thing, but I've seen it for a client where there was a home purchase we were making. And again, we knew there was going to be some bonus, some incentive from the company that would be coming within 60 days. And so we're able to go ahead, get the home under contract and get it closed and then pay it back within that 60 days. They can withhold from the IRA. Ideally, if you know you're going to put the amount back, again, you wouldn't want to have taxes withheld because when they're withheld, they are going to the IRS. So if you know that you're putting it back in and it won't be a taxable event, you just tell us, right? We're working with you to make sure that we set the tax withholding to 0. Only one per calendar year, as I mentioned. And if you fail to return it within 60 days, what happens? So let's say you take out $50,000 and you can't put it back in, any of it. That $50,000 that you took out is now earned income. It's now taxable income, as with any IRA withdrawal. So you're just going to add it to your taxes, probably need to make a quarterly tax payment now, right? Because we've taken that amount out and didn't have taxes withheld on it. Again, something we work with clients on. But if it doesn't come back, then now it is a taxable event. You took a distribution. If you're under the age of 59 and a half, then there could also be a penalty because you're not at the age where you're allowed to withdraw from it. If you take $50,000 out and you are able to just put back $30,000, whatever amount you can put back, you put back that $30,000, fine. The delta or difference of $20,000 is what the taxable income is. So it's not all or none. You can put back a portion if you want to. So again, not your number one, because that 60 days is a really tight turnaround. You have to be very certain that the incoming cash flow that you're expecting is coming in with that time frame to pay it off. So intrafamily lending. So this is the one that could be used for, again, this is not necessarily a bridge or short-term loan. It could be, but typically I would say where we've seen clients using this most recently is that given high interest rates and where home values are, if they have a child that is really ready to buy a home, they're poised to do it. But now with the rates jumping up to where they are, the monthly payments aren't sustainable. They can't afford a home, right, at the current rates and the current interest rates. And so again, intrafamily lending can be for really any reason. That's the most common one that I've seen lately, is you're using it to support a child for that home payment. So the benefit of it, there's a few, but one is that the interest rates that you can use, and they are posted, there are set kind of guidelines and rates that the IRS does want you to use. They don't want anyone just trying to say, well, here, son, here's the $200,000, you can pay me a 0.01% interest, right? Is another way to just kind of pass money along. So there are some rates that are published and you want to, stay within those rates or close to those rates, but they are significantly more favorable than current interest rates on a mortgage, for example, or most anything. So with those, you're looking in, the 3s and 4s for the interest that you would charge to your family member that you're loaning the assets to. So it can make it much more affordable. You can structure it to be interest only for the child to pay you back. Again, it's a way to make that payment more manageable for them to allow them to buy the home. They're also paying the interest back to you, not a bank. So you're keeping that interest within the family that you are earning on the loan. You do want to have this isn't just a handshake and here we go, here's the loan. So you do want to have it really well documented. As you can probably imagine, what the IRS doesn't want to see is that, again, someone's trying to use this as a way to kind of sneak and transfer wealth. And so you want to make sure if you were to ever be audited that you can easily document, here's the rate when I set it, here's the term that I agreed upon, here's the amount that they are paying back to me. So for the interest that your child is paying you, just like a bond or a CD, you, the person who's lending it, you're going to claim that interest on your taxes. You can forgive some of the interest and even principal up to the gift exclusion you see listed here of $18,000. So $18,000 is the amount you can give anyone without, eating into your annual gift exclusion. So, if you wanted to forgive that amount per year, you could do that. You just, again, have to be careful. If you're forgiving above the $18,000, or times 2 if they're married, then you do need to report it, that it was a gift, the portion that was forgiven above that. So again, it can be complex, and this is not something we're just going to say, here you go, I'm loaning you a couple $100,000 without having it well documented. I wouldn't recommend it. And so, that's something to think about, is just make sure, and there's a lot of online resources to do this. So I don't want to say it's impossible or over complex, but I do want to highlight the fact that you need to make sure this is in black and white, right? This is an agreement between you and the person you're lending it to. Inter-sibling jealousy. So, I think if you have multiple children, I have 3, and, we all think fair is equal. If you're making this loan to one child, someone could get a bit jealous. I think something that could be easily overcome just by a good family conversation, right? Especially if they understand this isn't a all outright gift. They are actually paying me interest back over this period of time, just to be really transparent with your family if you want to. So that's intrafamily lending. So again, you can select the loan term and the related interest to that. The payment structure, interest only, or do you want to amortize it and have some principal and interest? You really get to design it. So the IRS gives you some guardrails to use, but then you work with your child to design and do it as what works best for both of you. And as I mentioned above, be aware of implications of gifting and forgiveness. You just want to be mindful of that. Consider allowing a refinance if rates go even lower. Again, rates for these types of loans are, pretty much half of what you're going to see on, or close to it, on mortgage rates, so much more favorable. Document it and adhere to the terms. So just kind of qualifications you might consider when selecting an advisor, because I went over a lot of different topics today. And what I hope is that your takeaway isn't that you memorized every single thing we went over. We're not going to call and quiz you. But what I hope is that, if you do have a tricky transaction like buying a home before yours is sold, or if you do have a large unexpected expense and really want to pause to think about the most tax efficient way to finance that, I hope a couple of these come to mind to at least give you pause to say, let me revisit that, or really let me sit down with my financial advisor. We would love to have these conversations with you to really look through, what works best for you and your family specifically. We do offer, as I've said, I'll give you all one last kind of plug. We offer one-on-one financial planning and advice free of charge. It is what we do. It's what we do really well, and it's what the core of what we do. So if you worked with us and haven't talked to your advisor in a while, reach out to them. If you're very interested just to have an introductory call to us, please let us know and reach out. We would love to have the conversation with you. I hope you learned something today and enjoyed it. Thank you for your patience as my technical difficulties on the onset, but I hope it was a good use of your time, and let us know how we can help you. Bye.